Alright, let's talk about something most people avoid until the last minute: taxes. It's July 8th, 2025, and I know what you're thinking. Tax season just ended a few months ago. Why on earth would we talk about it now? Well, that's exactly why we need to. The biggest mistake you can make is waiting until next April to even think about your taxes. Starting now, at the beginning of the financial year, is one of the smartest money moves you can possibly make. It gives you time, and time is your most valuable asset when it comes to saving money. Procrastination is the enemy of your wallet. When you rush, you make mistakes, you miss deductions, and you end up paying more to the government than you legally have to, and we definitely don't want that. Think of it like this. You wouldn't build a house without a plan, right? You wouldn't just start nailing boards together and hope for the best. Your financial year should be treated the same way. Planning your taxes early is like creating a blueprint for your money. It allows you to see the bigger picture and make strategic decisions throughout the year, not just in a panic-fueled rush when the deadline is looming. This isn't about becoming a tax expert overnight. It's about taking small, manageable steps now that will pay off big time later. It's about being proactive instead of reactive. This simple shift in mindset can save you thousands of dollars and a massive amount of stress. The stress factor alone is a huge reason to start early. We've all been there, scrambling to find that one receipt, digging through emails for a donation confirmation, and hoping you didn't forget anything major. That last-minute chaos is completely avoidable. By tackling your taxes with a calm and organized approach now, you turn a stressful event into a simple, routine financial checkup. You can take your time to understand where your money is going and identify opportunities to be more efficient with it. This process gives you control over your finances, rather than feeling like your finances are controlling you. It's about building good habits that lead to long-term financial health and peace of mind. Ultimately, early tax planning is about maximizing your savings. Every dollar you can legally save from taxes is another dollar you can invest, save for a down payment, or use to pay down debt. When you wait until the end of the year, many of the best tax-saving opportunities have already passed. You can't go back in time to contribute more to your retirement account or make a strategic investment. By starting now, you have a full runway to make these moves. This isn't just about filing your taxes. It's about actively managing your tax situation throughout the year to keep more of your hard-earned money in your own pocket. Let's get into how you can do it. So where do you begin? The first step is surprisingly simple. Get organized. You need to become a collector of documents. Think of yourself as a financial detective gathering clues. Start a dedicated folder, either a physical one or a digital one on your computer for everything tax-related. This is where you will store all your pay stubs, bank statements, and any records of income you receive. If you're a freelancer, this means every single invoice and payment record. Don't just toss them in a shoebox. Create subfolders for different categories like income, business expenses, and donations. This small habit will feel like a superpower when tax time comes around. Next, let's talk about tracking your expenses, especially if you have a side hustle or run a small business. Every potential deduction is a piece of gold. Did you buy a new laptop for work? Keep the receipt. Did you pay for a professional subscription or a course to improve your skills? Document it. Use a simple spreadsheet or a budgeting app to log these expenses as they happen. Don't wait until the end of the year to try and remember what you bought back in January. By tracking in real time, you ensure accuracy, and you won't miss out on valuable write-offs that can significantly lower your taxable income. It's tedious, but it's worth it. It's also crucial to understand the basic tax rules that apply to you. You don't need a degree in accounting, but you should know the fundamentals. For example, are you better off taking the standard deduction or itemizing your deductions? The standard deduction is a fixed amount that you can subtract from your income, no questions asked. Itemizing means you add up all your individual deductible expenses, like mortgage interest, state and local taxes, and charitable contributions. A quick search online can tell you the current standard deduction amount. If your itemized deductions are likely to be more than that, it's worth the extra effort to track them carefully. Finally, review what happened last year. Your previous year's tax return is a fantastic roadmap. Pull it out and take a look. What were your biggest sources of income? What deductions did you claim? Did you owe a lot of money or get a huge refund? If you owed a lot, you might need to adjust your withholding or start making estimated tax payments. If you got a massive refund, it means you gave the government an interest-free loan all year. You could adjust your W-4 form with your employer to have less tax taken out of each paycheck, giving you more cash flow throughout the year. Once you're organized, you can start making strategic moves to lower your tax bill. One of the most powerful tools at your disposal is tax-advantaged retirement accounts. I'm talking about accounts like a 401k or a traditional IRA. The money you contribute to these accounts is often tax-deductible, which means it lowers your taxable income for the year. For example, if you're in the 22% tax bracket and you contribute $5,000 to a traditional IRA, you could save $1,100 on your taxes. The best part is that your money grows tax-deferred until you retire. It's a win-win. You save for the future and you save on taxes today. Another great tool is a health savings account, or HSA. If you have a high-deductible health plan, you might be eligible for an HSA. This is one of the best accounts out there because it has a triple tax advantage. First, your contributions are tax-deductible, lowering your income just like an IRA. Second, the money in the account can be invested and grows completely tax-free. Third, when you withdraw the money to pay for qualified medical expenses, those withdrawals are also tax-free. It's an incredible tool for both healthcare costs and as a supplemental retirement account if you stay healthy. Make sure you check if you're eligible for one. Don't forget about your investments. If you have a brokerage account, you can be smart about how you manage it to minimize taxes. For example, if you have some investments that have lost value, you can sell them to realize a loss. This is called tax loss harvesting. You can use those losses to offset any capital gains you might have from selling profitable investments. If your losses are greater than your gains, you can even use up to $3,000 of that loss to reduce your regular income. It's a strategy that turns a losing investment into a tax-saving opportunity, which is a pretty good silver lining. Lastly, think about charitable giving. If you plan on donating to charity, do it strategically. Instead of just giving cash, you could consider donating appreciated stock that you've held for more than a year. If you do this, you can typically deduct the full market value of the stock at the time of the donation, and you won't have to pay any capital gains taxes on the appreciation. It's a way to be generous, while also getting a significant tax benefit. Just make sure you get a proper receipt from the charity for your records. Every little bit of smart planning adds up to real savings. The key to mastering your taxes is consistency. This isn't a one-and-done task you do in July and then forget about. You need to build a system to stay on top of it all year long. The easiest way to do this is to set reminders. Go into your phone's calendar right now and set up a recurring monthly or quarterly reminder. Label it Tax Check-in. When that reminder pops up, take just 15 or 20 minutes to review your progress. File away any new receipts or documents in your tax folder. Update your expense tracking spreadsheet. Check your progress towards your retirement contribution goals. This simple habit prevents everything from piling up. A mid-year review is also incredibly important. Around June or July is the perfect time for a more detailed checkup. This is your chance to see if you are on track with your plan. Look at your income so far. Has it changed significantly from what you expected? Maybe you got a raise or started a new side hustle. If so, you might need to adjust your tax withholding or estimated payments to avoid a surprise bill next April. This is also a good time to project your potential deductions and see if you are still on track to itemize, or if the standard deduction will be the better choice for you. Life happens, and your financial situation can change unexpectedly. You might get married, have a child, or buy a house. All of these major life events have a big impact on your taxes. When something like this happens, don't wait until tax season to figure out what it means for you. Do a quick search online or consult with a tax professional to understand the implications. For example, buying a home means you can now deduct mortgage interest and property taxes, which could make itemizing a much better deal. Staying informed about how life changes affect your taxes is a core part of staying organized. By implementing these strategies, you transform tax season from a stressful deadline into a simple administrative task. The benefits are clear: less stress, more control over your money, and potentially significant savings. Early planning gives you the power to make informed decisions that benefit you all year long. The feeling of confidence you get from knowing your finances are in order is priceless. So, don't put it off. Start today, set your reminders, and make this the year you finally master your taxes. Your future self and your bank account will thank you for it.